The stock market just touched 5,400. Corporate America is printing money, literally $2.8 trillion in annual profits. The wealthiest slice of America, the top 0.1%, now commands nearly 14% of all national wealth, matching levels not seen since right before the 1929 crash. But here's what the champagne celebrations on Wall Street aren't telling you. Two-thirds of American households can't cover monthly expenses without their next paycheck. The national savings rate has collapsed to barely 4%, the lowest sustained level outside of recessions. And for the first time in modern economic history, market confidence and personal financial confidence are moving in opposite directions. One line soaring, one line collapsing. Two economies that no longer operate in the same reality. This isn't a glitch, it's a structural fracture. And if history teaches us anything, it's that when divergence reaches this extreme, something has to give. Let's break down exactly how we arrived at this breaking point and why the coming correction is not just likely, but mathematically inevitable. The income trajectory that broke. For 60 years, American families could count on something fundamental. Tomorrow would be better than today. From the early 1960s through 2008, real personal income grew at roughly 2.8% annually. Consistent, predictable, enough to plan a life around. That foundation shattered after 2008, and it never rebuilt. Between 2009 and 2019, real income growth averaged just 1.1% yearly, less than half the historical pace. Then came the inflation surge of 2021 to 2023. Factor that in, and over the past few years, real income growth has effectively gone negative for many workers. This isn't a temporary slowdown. It's a permanent break from trend. If incomes had continued on their pre-2008 path, the average American worker would be earning somewhere between $7,000 and $11,000 more per year than they actually are today. Multiply that across 160 million workers, and you're looking at roughly $1.7 trillion in missing household income annually. No policy tweak can bridge a gap that massive. The deeper problem isn't just the dollar amount. It's the destruction of expected income, what economists call the foundation of all major financial decisions. When people plan mortgages, start families, or save for retirement, they're betting on stable future earnings, not just current paychecks. When that expectation collapses, so does long-term economic confidence. This explains why consumer sentiment remains depressed even when unemployment stays low. People feel poorer because, relative to where they should be, they are. Meanwhile, productivity keeps climbing. Since 1980, worker output has surged over 70%. Real compensation? Up only 18%. The value workers create and the share they capture have never been more disconnected. The gap represents the largest income efficiency failure since World War II. Income didn't just slow down. It structurally detached from the economy it's supposed to power, the asset supercycle nobody talks about. While paychecks stagnated, something else exploded: asset prices. Since 2010, the S&P 500 has rocketed nearly 300% after inflation. Real personal income over that same period, up maybe 50%. Markets expanding 6 times faster than the wages meant to support them isn't normal growth. It's a distortion powered by extraordinary financial engineering. Ultra-low interest rates persisted for over a decade. Quantitative easing programs pumped more than $8 trillion into the financial system. The result? Asset valuations inflated far beyond what corporate earnings or economic fundamentals could justify. The multiplier came from capital flooding the system, not from actual productivity gains. This created a compounding feedback loop. Those who already owned assets, stocks, real estate, private equity, watched values skyrocket. Those who relied exclusively on wages, roughly 70% of households, got locked out of the wealth engine entirely. Between 2010 and 2024, U.S. household net worth surged by over $80 trillion. But the vast majority of that windfall flowed to the top 10%. The bottom half saw almost nothing. When one group compounds wealth at 6 times the rate of another, they're no longer participating in the same economy. They're living in parallel financial universes. The asset boom also transformed investor behavior. When treasury yields hovered near zero, the traditional model of safe saving collapsed. Pension funds, endowments, even ordinary savers had no choice but to chase riskier returns, just to preserve purchasing power. Money that used to sit in bonds got pushed into equities, real estate, and speculative assets all rising faster than the underlying economy. This is what creates a pressure vessel. Asset prices accelerating exponentially while income grows linearly can't stabilize on its own. The imbalance grows until something external policy shifts. Inflation shocks. Capital flight forces a violent realignment. The asset supercycle isn't an anomaly. It's the mathematical setup for what comes next. When households lose their shock absorbers, while asset owners enjoyed historic gains, something quietly eroded for everyone else. Financial resilience. The basic buffer that protects families from unexpected shocks has thinned to dangerous levels. The U.S. personal savings rate averaged 12-13% during the 1,980 seconds. Today, it sits around 3.8 to 4.6%, the lowest sustained reading outside of recession periods. A nation once capable of weathering downturns through accumulated savings now operates with virtually no margin for error. This didn't happen in isolation. It occurred alongside the most aggressive expansion in corporate profitability in modern history. Since 2000, average S&P 500 profit margins climbed from roughly 7% to nearly 12%. Many megacap firms now consistently report margins above 20%. The framework shifted. Households got structurally weaker, corporations got structurally stronger. It's a mirrored imbalance, one line collapsing, the other accelerating. The consequences are profound. Low savings leave consumers vulnerable to even minor disruptions. Nearly 45% of Americans report they couldn't cover a $400 emergency without borrowing. As savings vanish, reliance on debt explodes. Total consumer credit has surged past $5 trillion. Credit card balances alone hit $1.3 trillion, an all-time high. When interest rates spiked after 2022, the cost of carrying that debt exploded, pushing delinquency rates to their highest levels since the Great Recession. Meanwhile, rising corporate margins redirect national income away from wages and toward profits. Roughly 60% of corporate earnings flow to shareholders through buybacks and dividends, capital that compounds into more asset ownership rather than circulating through the real economy. This feedback loop amplifies inequality and suppresses the very savings households need to withstand volatility. The contrast is stark. Corporations sitting on record cash reserves exceeding $4 trillion, while nearly half the population can't handle a financial emergency. This imbalance creates a systemic fault line. When households weaken and corporations strengthen simultaneously, the economy tilts toward fragility. The system's shock absorbers are gone. A reset becomes inevitable. The housing choke point. Everything converges most violently in one place: housing. Shelter isn't just essential, it's become the primary mechanism, extracting wealth from American households. For 6 decades, home prices hovered around 4 times median household income. Today, that ratio has escalated to nearly 7 times, creating the least affordable housing environment in modern U.S. history. This isn't cyclical, it's structural. Home prices have surged over 45% since 2020 alone. Simultaneously, mortgage rates jumped from under 3% to above 7%, doubling monthly ownership costs. The effect compounds. Homes cost more, financing costs more, and wages haven't adjusted to offset either pressure. A typical mortgage payment now consumes more than 39% of average household income, far above the long-term standard of 25-28% that banks use to define stability. Renters face the same squeeze. National median rent remains over 25% higher than pre-pandemic levels, while vacancy rates hit multi-decade lows. Shelter inflation, now the single largest component of CPI, accounts for over 1/3 of the entire index. When shelter inflates faster than income, the entire structure destabilizes. Every extra dollar spent on housing is a dollar that can't be saved, invested, or used to build assets. Housing stops being a wealth-building pathway and becomes a wealth extraction mechanism. Institutional investors intensify the pressure. Large asset managers and private equity firms controlling trillions have aggressively purchased single-family homes and build-to-rent developments. In some regions, corporate buyers represent 20-30% of all purchases, permanently constricting supply and elevating prices beyond what local incomes can sustain. Housing transformed from a consumer good into a financial product, one priced not by wages but by yield expectations. The result? Mobility freezes, household formation collapses, younger generations get locked out of ownership entirely. When shelter consumes the system, every downstream metric deteriorates. Savings, consumption, investment, optimism. Housing isn't just strained, it's become the pressure valve through which the next phase of economic reset will trigger. The collapse of belief. Housing pressure doesn't just distort finances, it dismantles something deeper: confidence in the future. The U.S. economy never operated purely on numbers. It operated on expectations. And for the first time in modern history, those expectations have collapsed at national scale. In the early 2000s, nearly 3 out of 4 Americans believed their standard of living would improve over the next decade. Today, that figure has imploded to roughly 1 in 4, the lowest reading in decades of survey history. This isn't temporary pessimism. It's structural deterioration in economic psychology. Workers increasingly view upward mobility as mathematically impossible. Productivity rose roughly 62% since 1990, while inflation-adjusted compensation increased only 17%. That gap erodes belief in fairness, meritocracy, and opportunity. The equation where effort equals progress no longer computes. Household formation data confirms the shift. The share of adults aged 25 to 34 living with parents has climbed to nearly 22%, a figure not seen since the 1942nd. This isn't cultural choice. It's economic surrender. When shelter costs become insurmountable, the transition to independent adulthood stalls, and confidence in the future deteriorates with it. Financial insecurity surveys show over 70% of respondents don't believe they'll ever retire comfortably. Retirement account balances reflect that belief. The median 401 balance for Americans nearing retirement sits under $88,000, incapable of replacing income for even 2 years. A system dependent on long-term confidence cannot survive a population that no longer believes in long-term stability. When people stop believing effort produces progress, participation in the financial system erodes. Economic pessimism becomes self-reinforcing. And once collective confidence collapses, the reset stops being about charts or policy. It becomes an unavoidable shift in national mindset. Inequality at 1,929 levels. The confidence collapse isn't happening in a vacuum. It's unfolding alongside one of the most extreme wealth concentrations America has witnessed in over a century. The top 1% now controls roughly 31% of all U.S. wealth, while the bottom 50% holds just 2.5%. The top 0.1%, the ultra-wealthy, commands nearly 14% alone. These are distribution patterns last recorded in the late 1920s, immediately before the financial system fractured under its own imbalance. This isn't symbolic, it's structural mathematics. Over the last decade, the net worth of the wealthiest households increased by more than $30 trillion, driven overwhelmingly by gains in equities and private assets. During that same window, the bottom half added less than $1.5 trillion, a disparity revealing the asymmetry in compounding power. The investment landscape magnifies this divide. The top decile owns roughly 89% of all U.S. stocks, 92% of business equity, and over 70% of real estate value in high-growth regions. When markets rise, wealth accelerates upward. When markets fall, the majority feel no relief because they never benefited from the boom. Tax policy intensifies the divergence. Effective tax rates for the wealthiest, after accounting for loopholes and capital gains treatment, have fallen to levels not seen since the early 20th century. Meanwhile, payroll taxes consume disproportionate shares of middle-income earnings. Even wealth composition has shifted. High net worth individuals now hold unprecedented stakes in private markets, venture capital, private credit, private equity. These markets, worth over $12 trillion, compound returns away from public visibility and further concentrate financial power in inaccessible vehicles. This level of concentration is not sustainable. Historically, extreme inequality signals exhaustion in the existing model. When too much wealth converges at the top, consumption weakens at the bottom. Political instability rises, and the system loses the broad base required for durable growth. America isn't trending toward a 1,920 environment. It's already there. The data confirms the structural imbalance, and the pressure for systemic reset intensifies daily. The 1,929 blueprint. Extreme wealth concentration isn't new. It's the precondition that preceded every major economic reset in U.S. history. The decade before 1929 provides the clearest parallel. Corporate profits surged. Asset prices inflated rapidly. Wealth condensed into a narrow elite. By 1928, The top 0.1% controlled over 25% of national wealth, and stock valuations traded far beyond underlying output. The system was expanding without structural support, building pressure that demanded release. The trigger came from policy. Leading into the 1,930 seconds, aggressive corporate tax increases lifted top marginal rates from 11% to nearly 40%. This shift drastically reduced retained earnings, compressing profit margins when companies were already stretched by overproduction and tightening credit. Asset markets reacted violently. Between 1,929 and 1,932, stocks collapsed nearly 90%, wiping out equity value equivalent to hundreds of billions in today's dollars. Industrial production fell 47%, corporate failures surged to record levels, but beneath the devastation, a long-term rebalancing began. As profits contracted and taxes rose, the extreme concentration of the 1,920 seconds reversed sharply. By the mid-1,940 seconds, the wealth share of the top percentile had fallen by over one-third, the largest inequality compression in U.S. history. This wasn't incidental. It was systemic. When profit margins collapse, asset prices deflate, and tax burdens rise, wealth distribution restructures itself. The collapse forced capital to reprice, wages to renegotiate, and policy to reorient toward broad stabilization. What followed? High corporate taxation, aggressive regulation, and public investment formed the structural foundation for the mid-century middle class. The lesson is clear. Resets occur when wealth concentration reaches levels that destabilize demand, distort capital allocation, and erode social cohesion. The mechanics weren't random. They were the mathematical consequence of imbalances identical to what we see today. The convergence, the dynamics that fueled the last great reset are reappearing. But this time, the alignment is even more extreme. The United States now sits at the intersection of three conditions never before converged at this magnitude: historically low corporate taxation, historically high wealth concentration, and historically weak real income growth relative to asset prices. The combination forms an economic pressure zone with no precedent in the post-war era. Corporate tax policy is the first fault line. Effective federal corporate rates have fallen to roughly 15%, the lowest sustained level since the early 1,930 seconds. This allows margins to stay artificially elevated even as household budgets deteriorate. Wealth inequality has reached structural extremes. The top 1% now captures over 40% of all new wealth created. When too much purchasing power concentrates at the top, broad consumption becomes insufficient to sustain growth. The system runs on asset inflation instead of real economic strength. Income stagnation magnifies vulnerability. Inflation-adjusted median earnings have barely grown in 2 decades, up only $3,700 since the early 2000s. Meanwhile, essential costs like healthcare, education, and shelter have risen multiples faster than wages. Real discretionary income for middle-income households is at its lowest level in decades. When these three forces collide, the system becomes brittle. Low corporate taxes inflate margins, high inequality suppresses consumption, weak income eliminates household shock absorption. Financial stability depends on continuous asset inflation, an inherently unstable foundation. The conditions mirror structural imbalances that preceded earlier resets, but with deeper distortions and larger exposures. The reset mechanism. When inequality peaks, income stagnates, and corporate taxes remain historically low, the system enters a phase where the only remaining adjustment is structural reset. This doesn't begin with consumer behavior or market sentiment. It begins with policy. As fiscal pressures intensify and public demands for redistribution rise, corporate taxes become the first lever pulled. Even modest increases in effective rates compress margins, reduce buybacks, and weaken the fuel-inflating asset values. Once margins contract, repricing begins. Equity valuations adjust downward, credit tightens. Leveraged companies face refinancing stress, triggering asset sales, layoffs, and liquidity withdrawals. Asset price declines reverse decades of wealth concentration, redistributing power not through choice but mathematical necessity. As inflation unwinds, prices, savings capacity, and wage dynamics slowly realign with fundamentals. The divergence between Wall Street and Main Street closes not because conditions improve, but because financial excess collapses back to match the real economy beneath it. The system reconnects through one brutal mechanism: Wealth that inflated beyond reality must fall back to it. The two Americas cannot coexist indefinitely. One will force the other to adjust. And when asset values have expanded 6 times faster than the incomes meant to support them, there's only one direction that adjustment can go.